I am Jeremiah Ajodadusu, the author of JATS Business and Financial Accounting. Welcome to class again today. So let's not waste time. Of course, we've started consolidated profit and loss. Okay, so last class we looked at the scenario where, of course, the directors didn't deem any adjustment fit. So as we move forward, we're picking up adjustments one after the other, and then we're going to see how we expand the line items as we move on. So today we're taking an adjustment, okay, that can arise when preparing consolidated profit and loss account, of course approved by the directors. Okay, so today we're looking at of course it's group consolidated profit and loss. So today we're looking at let's call it intra-group sales, purchases, and what? Profits. Of course, if you don't want to use intra-group, you can say sales, okay, within the group. Of course, it can be sales. Then you have, or should we just say sales, purchases, and what? Profits within the group, okay? So what I'm simply saying here is that there is, sales or purchases between maybe the holding company and the what? Subsidiary, or let's say the subsidiary and the holding company. So what I'm saying is this. Of course, we have the holding company here, okay? And then we have the what? Subsidiary. This guy, let's say, remains what? A limited. Let this guy be what? B limited. So what we're saying is that this guy here is what? Selling, right? Selling to what? To this guy. Okay? So that means A's perspective, it will be what? Sales. B's perspective, it will be what? Purchases. Okay? So A is selling, B will be buying. Of course, it can also happen the other way around. It can be the subsidiary selling to the holding company. But here we're looking at, a scenario where the holding company is the one selling to the what? Subsidiary. Okay? So what it means is that, it means that A has sold, the holding company has sold, then the subsidiary has what? Purchased. Okay? So remember that there's something called sales and cost of sales. So let's say we have the holding company, and then we have the what? Subsidiary. Okay? Now, ordinarily, this guy sells. Okay? This guy sold, it will be sales here. Let's say 100 naira. Then there's something called cost of sales, right? Your cost of sales is a function. You have opening stock plus what? Purchases minus what? Closing stock. That's your cost of sales. That means if this guy is selling this product worth 100 naira, it must have a cost price or a purchase cost, right? So let's say it is what? 80 naira. So if it is sales toward the holding company, it will be what? Purchases to this guy. Okay, so let's assume that the subsidiary sold it, sold everything, let's say for 150. So that'd be 150 sales. So at this point, holding company is making a profit, which is gross profit here, of 20. This guy is making 50. So at consolidated level, which is CP and L, this will be what? 250. This will be what? 180. Right? And this will be what? 70 as the gross profit. That is because the product sold by the holding company to the subsidiary was also sold entirely by the subsidiary. But the question now is, what happens where the product sold by the holding company to the subsidiary was not sold? What happened where it was not sold? So let's say that the sales made by the holding company is 100 naira. Of course, that will be purchases toward the subsidiary. Now, what happens where it was not sold? What happens where it was not sold? So it means that what the subsidiary has the total product as a closing stock. Remember, cost of sales is opening stock plus purchases minus what? Closing stock. Right? Now, sales made by holding company 100. Of course, they purchase it for what? 80. The subsidiary bought it, which is 100 here. But the subsidiary has not sold it. So if the subsidiary has not sold it, that means there's no sales. I'm assuming that the only thing that is being sold by the subsidiary is one purchase from the holding company here, okay? Now, if the subsidiary has not, that means there's no sales. Now, if there's no sales, that means there's no what? Cost of sales, because your closing stock is a balance sheet item. It reduces your purchases for it to come to cost of what? Sales. So if what you purchase is 100, there's no opening stock, there's purchase of what? 100. And then it was not sold, that means it is a closing stock. That will be minus what? That means there's no cost of sales. So that means that the cost of sales here will also be what? Dash. Okay? So remember, there is a closing stock. That means the stock is still in the what? It's still in the warehouse of the what? Subsidiary. So appear in the balance sheet, right? But now we're not saying if we want to consolidate the P&L, it means that we're going to say 100 plus this, Abi. That would be what? 100. 80 plus that would be what? 80. Alright? So this should give us what? 20. Right? But now remember that this is a consolidation. It means you're bringing the holding company, okay, and that of the subsidiary to be what? 1. So now that they are 1, remember that this sales was made to the subsidiary. Okay? Now, if it is made to the subsidiary, and now at group level, we are not making them 1. That means the interpretation will be that what? The group is selling to itself, which is not possible. You can't sell to yourself. If we are reporting separately, holding company separately, subsidiary separately, then it can stand. But now you're trying to bring them to 1. And this sales here was made to the what? Subsidiary. So at group level, it is not looking as if the holding company is selling to itself, which is not what? Possible. Okay? So if the closing stock, okay, that is the stock sold, rather, by the holding company to the subsidiary is still in the store, which is the closing stock of the what? Subsidiary. It means that at consolidation, it will still remain a closing stock. Okay? So if it's a closing stock at subsidiary level, at consolidation, it will still be what? The closing. So it means that technically, that product has not been sold at what? At group level. So that means that this 100 naira here, okay, sales here cannot stand. So we have to adjust for it. So that means in our adjustment, this 100 there has to go out. Okay, so this 100 minus this 100 will mean that there's no what sales because you can't sell to yourself. So if you have not sold, then there can't be cost of sales. Because if you're going to do sales minus cost of sales, you're trying to get the cost of what you have actually sold. Now they are saying that the sales cannot stand. So it will mean that what? The cost of sales can also not stand at group level. So that means we have to adjust for this as well. Okay? So that means this will also go off. Okay? So now we're having this. If there's no sales, there's no cost of sales, then the profit too cannot stand. So we have to also adjust for this. So this will also nil off. So what we're technically doing is that we are, adjusting for what? For the sales made to the subsidiary. Okay? But the subsidiary is here to sell it at the time we are reporting. So at group level, it will not look as if the holding company is selling to itself, which cannot be. You can't sell to yourself. And then remember, the subsidiary is buying from the holding company. So at consolidation, it will not look as if you are buying from yourself, which is also not possible. So there has to be an adjustment. Okay? So technically, that closing stock of product that was sold within the group, okay, so long as it has not been sold out of the group, that is the entity buying has not sold and it's still remaining there and we are consolidating, it will remain the closing inventory of the group. So at group level, intergroup sales that is yet to be sold, that is, it is remaining in the warehouse as at when we are reporting, has to be adjusted for. So any profit element on that product also has to be adjusted for. That's what we've done here. So you can see that at individual level, they are standing. But because we are now consolidating, okay, we now have to adjust for it. If we're reporting separately, then they can stand. Of course, holding company has made sales, subsidiary has made purchases, just that it has not been sold. But now at group level, it will not look as if they are selling as if you're selling to yourself. So you have to now eliminate it. That's the essence of the adjustment. Okay, so the simple thing I'm saying here is that where there is an intra-group sales, or what we call sales and purchases within the group, once you're able to establish that the product that has been sold or purchased within the group has not yet been sold, as when we are reporting, that means they are still in the warehouse. We have to eliminate it at group level. Okay, so this is a summary of intergroup sales or purchases and profits as it affects consolidated profit and loss. Okay, so take your time, go through. If you have questions, you can reach me on the numbers displayed. I'll just reply with the right answers. So let's take a question so you can quickly understand what we're talking about here. All right, let's quickly take this question so you get the point here. So we have the following the income statement of Kings PLC and Queens PLC as at 2018. So we have Kings and Queens, turnover, cost of sales, gross profit, total expenses, profit before tax, taxation, profit after tax, proposed dividends. Okay, retained profit for the year, retained profit brought forward, retained profit carried forward. So we have additional information there. Kings PLC acquired 90% shares in Queens PLC on 2016 when its profit was 1 million naira credit balance. Okay, goods worth 980,000 naira plus 25% profit margin inclusive in bracket sold to Queens PLC by Kings PLC. We are yet to be sold by Queens PLC at the date of reporting. We are required to prepare the consolidation schedule and then 2, consolidated income statement for the year ended 2018. Okay, so let's quickly look at this here. So what do? We have consolidation schedule here. Okay, so we have kings, queens, are just going to be here. Then we have C, P, and what? L. So let's go. What's the turnover for kings? 16 million, 11 million. So we have 16 million, 11 million. What do you have there? Cost of sales 9.8, 6.1. So what do we have now? Gross profit. What's the gross profit we have there? 6,200, 4,900. Okay. So what's the next thing? We have total expenses. These are all in the question, eh? Total expense, there we have 4.22020. So what do we have here? Profit before tax is 2 million. It's 2 million. It's 2880. So we have tax here. What's the taxation here? 640. What do we have here? 922. So what's that? Profit after tax. This is 1360. Then we have 1958. Okay. So that is what we have here. But now there's an adjustment. They said that goods worth $980,000, 25% margin inclusive, sold to Queens PLC by Kings. We are yet to be sold by Queens PLC at a date of reporting. So that's intra-group sales and what purchases. So we have 980,000 sales, 25% margin inclusive. So that means the cost plus the margin. Margin is what? 0.25 of the cost. What will be equal to 980,000. So this is 1.25C. So this cost now will be 980 over 1.25. So what do we have? So this is 784,000. So if the cost is this, then what's the profit? That will be equal to 980,000 minus 784,000. So what do you have? That's 196,000. So remember, this is the product sold by the holding company to the what? Subsidiary. The holding company is King, subsidiary is Queens. Okay? So what do you have now? this is an intra-group sales, or sales within the group, right? It's an intra-group sales. So, but then they say it has not been sold. That means even though this guy sold and this guy purchased, it is part of closing stock. That means what has not been sold. So at group level, okay, it has to be what? Adjusted for, right? So that means the sales cannot stand here. You can't sell to yourself, right? So how much is the sales? 980. So we have 180. What's the cost of the product? So we have 784. So this will be the profit, 196. So let's go. $16,000 plus 11,000 minus 980, 26,020. Cost of sales there. 9,800 plus 6,100 minus 784, 15,116. So we have 26,020, okay, minus 15,116. 10,904. So if you check this, this should be like this. Let's check it. $6,200 plus 4,900 minus 196. So this is the gross profit. So let's, what are total expense now? Well, that's the only adjustment, okay? So we have this plus this. What do we have? $4,200 plus 2,020. That's 6,220. So when you take this out, what will you have? $10,904, okay, minus 6,220, 4,684. What's the tax? What's the tax? 640 plus 922. We have 1562. So what do you have? Profit after tax would be what? $4,684 minus 1562. We have 3,122. So this is the profit after tax. So we can do, to say, Kings and its what? Subsidiary. Consolidated profit and what? Loss for the year ended at the 1st December 2018. Okay, so what are turnover? 26,020. Cost of sales 15,116. So I'm thinking that we have 10,904. This is the gross profit. Total expense. What do you have? 6,220. think that I have 4684. This is the profit before tax. What are our tax? 1562. Right? So what do you have? 3122. So we have profit after tax. Okay? So since we have this, remember it includes the holding company and what? And the subsidiary. Or the minority interest in that sense, right? So this is the profit after tax for Queens. Of course, we're going to have that of the minority interest, that's what? Subsidiary. So holding company has how many percent? Question says 90%. Is 90%. Minority interest is 10%, right? So minority interest will be what? 10 over 100 times 1958. Zero point 1 times 1958 times 195.8. So we say less minority interest, 195.8. So what do you have? $2926.2. Okay, so this is what? Profit what attributable to the holding company or to the group, eh? So from this, you can pay your proposed dividend. So what's the proposed dividend of the group? $272. So what do we have? $2926.2 minus 272. We have 2654.2. So this is what? Retained profit for the year. So we say what? Retained profit brought forward. So what do we do? Let's do it here. Brought forward, right? So holding companies retained profit brought forward. What do we have? 4130. So we now have what? That of the subsidiaries brought forward is 2850. So we have 2850 minus the pre-acquisition reserve is 1 million. Minus 1 million. That's what? 1850. So times 0.9. What do you have? $0.9 times 1850. 1665. So we add up plus 4130. 5795. So we have 5795. So we add up plus 2654.2. 8449.2. So this is what? Retained profit carried forward. So this is a simple illustration for what consolidated profit and loss that deals with intra group sales. Okay, purchases and profit, of course. All right, so take your time, go through it. If you have questions, you can leave your numbers displayed and let's reply with the right answers. Okay, bye. See you next class.